Oh, we got a lot of seats in the front, so come on in. All right. All right, it's official. Welcome to LendIt 2013. This is not just another conference. This isn't even just the inaugural online lending conference. This is the future of global banking. My name is Dara Albright. I'm founder of Now Street, and I'm a proud co-producer of LendIt. In my 21 years on Wall Street, I had the privilege of organizing some pretty groundbreaking events. And I have to say that the enthusiasm for this event today is unlike anything I had ever seen before. And I believe that's a result of two factors. One, the massive desire for economic and market transformation. And two, the enormous impact that P2P is making on the global credit markets. I'm so honored today to be surrounded by so many of the P2P and online lending pioneers. You guys possess the vision that make this day a reality, make these markets a reality. And I'd really like to just thank you all for being here and thank all the participants, all the attendees for being here. Just to really thank everyone individually, I just want to say first, I really want to thank our speakers who so generously share their wisdom and their insight, our sponsors who make events like this economically possible, and of course our attendees, most of you made up of investors who provide the funding that makes emerging and developing markets like this actually thrive. And of course, all of the leading and emerging online lending portals that are helping capital flow, once again, to consumers, to students, to entrepreneurs, and to innovators across the globe. And finally, I'd like to thank my co-hosts, Jason Jones, partner at Disruption Credit, and Peter Renton, founder of Lend Academy. I can't tell you how much of an honor it is to work with you guys, and I can't tell how much I just really admire and respect your work. I think you guys are just incredible. We're just going to do a little bit of some housekeeping before I turn the mic over to Peter. That's us. A couple of notes. First, we are broadcasting this live. We're trying to get that straightened out, but it will ultimately be live. We're also filming the entire thing. So we'll make that also available in case you miss any of the presentations. You also will have access to all of it at the conclusion of the show, especially for anyone that missed any parts of the presentations or discussions. We do have Wi-Fi in the area. The Wi-Fi is the signal is convene meeting. Convene conference center, and the code is meetings. Lowercase, all lowercase. The bathrooms are by the front of the reception. And we are going to try and adhere as much as we can to the schedule because I'm in big trouble with Jason if we don't. So I'm going to ask the speaker, please, everyone, keep to the scheduled time allowed. And right across the hall, so when the presenters finish their segment, right across the hall, we're going to have breakout sessions. And we'll be able to just continue the flow, continue the discussions, and continue the dialogue. So, feel free to then, move around and then move out to the breakouts if you have further questions. And with that, I'm going to hand the mic over to... and workshops. So in your program, you'll see there's also a schedule for workshops. That's in the Rockefeller North Room on the side. Those will start about 10:50. Those will start. It just takes kind of a deeper dive into some of the discussions, and they're all outlined in your package as well. And I think that's about it. Okay.
So, anyway, let's get started. So for those of us who have been around this industry for any length of time, our keynote speaker this morning needs no introduction. He is the founder and CEO of Lending Club. He's taken this company from just an idea in his head through to today, where in the next couple of weeks they're going to cross $2 billion in loans issued. They are the undisputed world leader in online lending. And I'm really excited actually to hear this presentation this morning. So without any further ado, I would like you to welcome Renaud Laplanche. How do I get the slide? Oh, yeah. Of course.
Thank you, Peter. So I've been, over the last couple of years, I've been walking around and saying that Lending Club is planning to transform the banking system. And amazingly, nobody has really asked me, okay, what do you actually mean by that? So I've been getting away with that catchphrase for a couple of years now. And Peter, as always, has been the one asking the right questions and asked me to elaborate on, okay, how exactly are you planning to transform the banking system? So let me tell you more about our plans. I'll give you a chance to read the disclaimer, if you can, and that's it. All right. So taking a step back and looking at the sort of history of innovation and disruption in other industries than banking and consumer lending, we all have a sense that technology is going faster and the pace of innovation is going faster. And certainly, if you measure the time it took for electricity to be getting 100% penetration in households, it took a lot more time than sort of more recent inventions. But when you take a closer look at the data and more granular look at the data, it gets really interesting. And you see that, for example, someone who was born at the end of the 19th century, when the telephone became commercially available, actually had little chances to own a telephone within his lifetime. And now fast forward to some of the most recent innovations. Someone who was born just 4 or 5 years ago has more than a 50% chance of seeing a tablet computer in their home by the time that person is age 4 or 5-year-old. So there's been a big acceleration, and innovation is getting adopted faster, and technology innovation is getting adopted faster. So it's interesting to look at how incumbents typically react to innovation. And the typical pattern is that incumbents react too late and too little too late. And certainly Borders launched an e-book store, but that was a couple of years before filing for bankruptcy. Blockbusters started shipping DVDs like Netflix did, but that was also too little too late and couldn't prevent Blockbuster from being overtaken by Netflix and also filing for bankruptcy a few years later. And so what's interesting about innovation is the incumbents also not only sort of create new products and better service, better value for consumers, but also very often spur a cycle of innovation. And some of the incumbents do try to compete. And certainly we wouldn't have a Nook reader today launched by Barnes & Noble if Amazon hadn't launched a Kindle. And then the Nook created an incentive for Amazon to push the envelope further and release the Kindle Fire. We're also seeing benefits for consumers in terms of pricing. So just in the last holiday season, Target and Best Buy decided to match Amazon prices for that season. So you see a really positive impact on consumers, both in terms of product and services, but also in terms of pricing. So looking more closely now at the sector that's of particular interest to us, which is the financial sector. The financial sector has grown quite rapidly over the last 60 years, less so in the last 10 years, but basically grew from less than 3% of the GDP to now about 8%, and is now the largest industry in the US. And despite of that fast growth, we haven't seen a lot of innovation coming from the large banks coming from the incumbents. A lot of the innovation in the financial sector actually has come from outside of the large banks. So the first credit card, arguably the biggest innovation in banking in the last century, came from Diners Club. The ATM was proposed by its inventor to Citibank in the 30s, was rejected, and was finally adopted by the banking industry much later in the 60s. And more recently, we've seen a large number, hundreds of mobile payment companies really spurring another wave of innovation, in particular in mobile banking, that has seen a very fast growth, a 50% year-over-year growth, with companies like Check really changing bill payments, with companies like Square helping push the adoption of credit card payments for smaller merchants, and GoBank really releasing the first truly native mobile banking application. So a lot of innovation, but coming from outside of the industry leaders, outside of the incumbents, not being driven by the incumbents, as we've seen in other sectors. The other thing that has happened to banking over the last few decades is that large banks have really taken over retail banking, and a handful of banks now represent the majority of retail lending, and that's particularly true in credit cards, where the 7 largest issuers represent over 75% of outstanding receivables. And what we've seen, partially as a result of that concentration, is that the credit cards balances have certainly grown very fast in the last 30 years, up until a peak in 2008, and that has slightly slowed down since, but still represent about $850 billion. And but the benefit of that growth has really gone to the issuers, not so much to consumers, with the cost of credit card and the spread between credit card rates and the risk-free rate having increased considerably over the last 30 years, going from a 200 basis point spread over Treasury to now a 1,400 basis point. So if you look at the actual interest paid by consumers over the risk-free interest rate, it was $1.2 trillion in the 80s, and it went up to $10.8 trillion in the 2000s decade, as a result, again, of balances increasing, but also the spread increasing, and credit cards becoming really more expensive for consumers. So on top of high interest rates on credit cards, what we've seen is the banks driving profitability in recent years through additional fees and cost cutting. And the cost cutting really have not helped with customer satisfaction. If you look at the NPS, so the Net Promoter Score in the banking industry, you find that the large banks are really net detractors by a pretty big margin, and have a Net Promoter Score in the single digit, which is particularly low. And credit cards are also in the credit card issuers also in the single digit. In comparison, regional banks, community banks, and credit unions are doing a much better job at serving their customers, delivering value to their customers, and keeping them happy. So what we're seeing in the banking sector is really a concentration with the big banks representing the majority of industry, a handful of banks representing the majority of industry, and a model that's really characterized with a lot of cost, a large branch network, a lot of IT legacy systems, and the branch networks with the thousands of branches and tens of thousands of employees that was built in order to collect the deposits, but fulfills less of that function today. But also a lot of risk in the banking sector. And when I was talking about risks in the banking sector in 2007, I had a weaker case than I do now. I think 2008 and 2009 have made the point that the extraordinary amount of leverage in the banking system, with the banks being levered up 1-8 or 1-9, is creating a tremendous amount of risk in the system. Comes Lending Club. So what we've done is we've really radically transformed the way consumer lending operates. We've de-risked it with a perfectly matched asset and liability, with no risk of a run on Lending Club, with no inherent leverage in the system. We've also less cost than the banking system. So we have no branches. We use technology to lower costs. And one of our investors has requested a study from McKinsey recently that shows really line item by line item how Lending Club drives cost out of the system and how much more efficient we are than the banking system. And the result of that survey was that Lending Club has a 425 basis point cost advantage against the banks. So 400 basis point less cost, and that cost saving can be passed on to both borrowers in the form of lower interest rates and investors in the form of attractive returns. And that has helped us grow in a pretty consistent way over the last few years. As Peter mentioned, we passed our first $1 billion in loans in November last year. So it took us about 5.5 years to get to the first billion, and only 6.5 months to get to the next $1 billion. So we probably pass a couple of $1 billion by early July. And so if you look at sort of total loans outstanding in the industry, in the consumer peer-to-peer lending industry, that the total loans outstanding have passed also the $1 billion recently, and it's closer to $1.2 to $1.3 billion now, with Lending Club representing a bit more than 80% of that total. What's interesting is the loss rate, the credit characteristics have become very, very predictable, very repeatable, very, very sustainable. You can see, sort of looking at the last few vintages, how loss rates have performed. And we've also done a good job at keeping customers happy and at really delivering value to our customers. Unlike the big banks, that again have a NPS score in the single digit, we've recently measured our NPS, and the reading is 79%. And that's one of the highest score in banking and financial services. And we're very proud of what we've achieved there, because that's really our mission, making sure we deliver a great experience to borrowers, which not only serves borrowers well, but also serves investors well, because good experience helps create positive selection and attract the kind of borrowers that you want to see as an investor. And investors, as a consequence, have been really flocking to us with the self-directed retail base growing very nicely, and other type of investors joining the platform, and now the platform having a very diversified investor base, including retail investors, high net worth individuals, family offices, third-party fund managers, and direct institutional investors. So the future of Lending Club, and then I'll talk about how that fits into transforming the banking system. So we've started with consumer loans. We're going to start releasing new products in the next year. And we're starting to have teams working on products that we'll be releasing in several years from now, including possibly cars, insurance products, mortgages, and a number of other products that will come in the next few years, and expand internationally to the rest of the planet and beyond. You heard it for the first time at the LendIt conference. So what can or what we believe should the banking industry do with respect to Lending Club and to the online lending industry? So it's interesting to look at other industries and what other incumbents have done. So if you look at the music industry, after the sort of Napster episode, once a credible player has come up with a compliant way to disintermediate or to make the product directly available to consumers at a lower cost or in a more convenient way, then the industry has joined that platform, and the music industry has worked with Apple. It took a few years. There were bumps on the road, but that partnership is now working very well, and Apple announced recently 25 billion songs downloaded on iTunes. If you look at what happened in the retail sector with eBay, the retail industry and the manufacturers initially rejected eBay and feared eBay as a new entrant, as a disruptive company. But more recently, sort of car dealers have been working with eBay Motors and selling new cars now on eBay. And the retail industry and product manufacturers have increasingly been working on eBay and have really decided to join the platform and benefit from the platform as a more cost-efficient, more user-friendly way to reach their customers. So we believe that could be a model for the banking industry. So when you look at the Lending Club platform today, we have the very diverse sources of capital, diverse origination channels on the borrower side. And we announced this morning, we put a press release on the wire this morning, we announced that the first 2 banks have joined the platform. So those are 2 community banks called Congressional Bank and Titan Bank out of Maryland and Texas. And these banks and the ones that will join them over the next few weeks and months really are benefiting from the platform as a way to acquire assets that they could not necessarily originate directly, but also as a way to work better with their own customers. And so in the case of Titan Bank, they will sort of contribute their customers to the platform as well, and really rely on Lending Club to underwrite, originate, and service these loans in a way that's more cost-effective than most of the banks would. So we're seeing this as the beginning of a trend in which the banking industry, so starting with the community banks that care the most about their customers and have been doing the best job really at serving their customers and keeping them happy and delivering great customer satisfaction. We see them as pioneers. I think when we look back in a few years, we'll see that Congressional Bank and Titan Bank really were the first 2 banks and were pioneers in adopting sort of direct lending as a way to better serve their customers, and again will be seen as the first incumbents who adopted online lending as an innovation. That's all I had today. Thank you. Time for questions.
Okay, we got time for like 1 or 2 questions. Yeah.
What is the IPO of
You get that every time, don't you?
Yes, I do. So the question is, when is Lending Club going public? The answer is we believe we will be ready for an IPO sometime next year, so sometime in 2014, and we'll decide to pull the trigger depending on market conditions.
Yeah.
So you announced that today with the banks. What type of negotiations or how has that? How did you get those banks, and did they come to you? Did you go to them, and how do you see that whole? Is that a test for you, and do you see that going upstream to larger banks? And where do you see that?
Yeah, so we really see that as a beginning. See this relationship with these 2 community banks, and we initiated these discussions.
Are you looking for more community banks?
Yes, we are looking for more, and we are in discussions with many more. And what's interesting is the bank's participation from the standpoint of Lending Club is really helping us better serve our customers and be more helpful to more people, because they play in a very different part of the credit spectrum than the existing Lending Club investors. Right now, there is a lot of interest from individual investors and institutional investors in the more sort of aggressive, in the middle of the road and the more aggressive part of the platform. There's actually quite a bit of competition now for the loans. The banks are playing in the part of the platform that's currently not being overcrowded by investors, actually has very little demand, so the A grade and possibly a double A grade that we would be releasing and be able to move up the credit spectrum and have a sort of lower yield, higher credit quality type of loans than what we're doing now. So do more A grade and possibly double A, and possibly also go longer in duration, while our existing customer base tend to focus on higher yield, shorter duration.
That's actually all we have time for. So thanks, Renaud.
Right, thank you.